What up, guys? It's January 24th, and hopefully we're not glitching today like the New York Stock Exchange, which had that crazy glitch. I woke up this morning, and I saw a Palantir down like 16-17%. I went, what the heck? Like, no way. There's no news that could drive a stock that far down in that short amount of time. And, of course, I opened my phone, and I saw the glitch, and I was like, okay, whatever. They'll fix that. Hopefully you didn't put any trades that are going to be kind of, busted when you try to cash in your profits on those trades. Hopefully that doesn't happen to you. If you were able to get Palantir and other stocks like a Home Depot or even Microsoft at like a huge discount, good for you. Hopefully you can check in with your broker and they're not going to bust those trades if you're planning to trade them, okay? Probably want to hold those for the long term and see what happens, okay? Now, of course, we talk about the trading glitch. We're going to talk about the earnings and all the numbers from the market today and kind of what's going on with several companies reporting earnings. Before we get started, of course, please hit that like button, hit subscribe. Hopefully you learned something from these videos and we have some fun in the meantime. All right, let's get to it. So here we go. Let's start with the numbers today. And we'll start with the Dow Jones, the outperformer on the day, up 0.3%. Not by a lot. Nothing too exciting there on the Dow Jones. Yeah, it's recovered a bit, but it is what it is. So the S&P 500 down less than 0.1% right there. So not much to fret about there. Pretty much flat on the day. Forward PE, I put this up here because I think it's worth mentioning every time. Forward PE for the S&P 500, 19.52 times earnings. Expensive. Looks and seems expensive. Okay, so be careful of this, right? When the market right now above 16, it's the historical average. You're paying a premium for a lot of things. And we'll talk a little bit about a couple of stocks that you're paying a premium on, including Microsoft. Okay, and the NASDAQ down a little bit under 0.3%. Russell 2K matching the NASDAQ. Remember, these two have been sort of linked lately, okay, in the market. Now, when it comes to the VIX, under 20, we've talked about that before. We don't want to start a position unless it's much elevated, probably looking at a level above 25 to 28. To start positions and to take advantage of volatility. Bond rates down today on the 2-year yield and down on the 10-year bond yield as compared to our last video yesterday, okay? So pretty good there. Yield curve inverted. We talked about that before. All that recession and how it predicts, 12 out of the last 6 recessions, all right? Now, energy down today, 80.22. Brent, 86, down from 88 as of yesterday, and natural gas still falling off a cliff. I mean, the fall has been incredible for natural gas. 341 as of last video, 316 today. Good for Europe if that's you, okay? Now, 101.90, the strength of the dollar, pretty even with our last video yesterday, and we're focusing on earnings. Week 2, we got massive earnings to talk about. We don't know whether the bull market is still in effect, whether it's a true bull market or if a head fake, right? We don't know what's going to happen, so it's still in question, and the only thing that's going to answer that question are earnings. We're going to talk about Microsoft, Texas Instruments, DR Horton. Our Fidelity portfolio today down about a little bit under 0.9%, essentially $872. We're up $12,000 in the past 30 days. All right, now let's bring the focus to earnings. All right, I want to talk about Microsoft. Okay, so they reported earnings today, and essentially not as bad as feared. Okay, not bad. And we'll go over the charts in a little bit as to why the stocks react the way they do to these earnings numbers. Okay, so essentially here, beat on EPS, that's the measure of profitability, earnings per share. Revenues are lower than expected by about $200 million, and they guided below the expectation. So it is a slight earnings miss for Microsoft. They talked about 2% year-over-year growth, nothing impressive there, but not entirely unexpected, okay? Now, the intelligent cloud revenues, 18% year-over-year. We have productivity and business products. That's your kind of like your Microsoft Teams and things of that sort, 7% year-over-year increase. That's great. Personal computing revenues down. That's 19%. That's devastating. We're talking Xbox and Windows and PC products down 19% year over year. Also, not entirely unexpected. The market has baked in a lot of PC weakness. Go ahead and ask us, AMD shareholders, about PC weakness. We know all about it. All right. Now, Azure Cloud is a strong thing, right? 31% year over year growth, but it is decelerating growth. It is growth that is not showing as strong as before. So you have to watch out for decelerating growth there. But ChatGPT, their investment in OpenAI, ChatGPT, there's a lot of hype around that. So that brings on hype here, and it's sort of hype prices a stock kind of weird. It always puts a premium on a stock, and I think Microsoft has that Microsoft premium, and now it's going to have that ChatGPT OpenAI premium on it. How that gets priced into a stock, I don't know, but you bet there's a premium for that hype baked into that stock. Okay, now they're going to have to keep cost cutting, and we already know about severe layoffs at Microsoft, and I think they're going to have to keep doing that to protect EPS, which means profit. That's another word for profits, okay? And then operating margins declining about 1%. That's also something the street doesn't want to see. But again, not as bad as feared. So you would think that Microsoft here would be in a terrible situation as according to their stock. Let's take a look. And here we bring up the Yahoo Finance chart and data for Microsoft. We see it's not that bad, guys, right? On the day, losing 0.2%, and then after market down 1% after reports earnings. Not bad at all, guys. Not bad. So I know it was up after earnings about 4 to 5% after they reported the earnings numbers. When the conference call took off, this is when that flipped on the charts and it went to a negative number. This is why you don't go rush in to buy a stock after the earnings report. You have to wait for the conference call to get context as for everything that's being said or everything that you need to take into consideration or that the street is taking into consideration in the conference call. So don't be one of those people that rushes in to buy a stock right before earnings, right after earnings. You got to wait for that conference call and make a good decision there, okay? But again, not as bad as feared from Microsoft there. Now let's move on to Texas Instruments, right? So 213 EPS versus 198 expected. That's a pretty healthy beat on profitability. Revenues also beat nicely, 4.67 versus expectation of 4.27, so by about 400 million, and guided above expectation by about $900 million. That's great earnings at face value. Again, we have to wait for the conference call to see what happens. We don't own any of these two stocks, right? We kind of pay attention to Microsoft for the health of the market, the health of the technology sector, and Texas Instruments because we own 3 semiconductor names in our portfolio. We want to see what these semiconductor companies are reporting. So they're saying, hey, our revenues are decreasing 11% year over year. Negative, right? That's not good. And even worse, 3% month over month. That's a severe slowdown in their business, okay? But this is as expected or baked in. This is something that Texas Instruments sort of already guided for in the market, already expected this decrease in revenues, okay? They're saying weak demand across all end markets except the automotive side, and that's something that we've been talking about for a long time, automotive exposure to semiconductors. We have that exposure through NXP Semiconductor, and we know that automotive and the transformation to electric vehicles is going to exponentially increase the demand for semiconductor chips that go into cars and trucks. So very, very well placed so far from our perspective, okay? Free cash flow, 30% of revenue. That's always healthy. That means that they can return money in buybacks, dividends, things of that sort, okay? They invested $3.4 billion into R&D and SGA. SGA is sales, something, and administrative. That's sort of like just paying down some administrative costs. And then $2.8 billion in capital expenditures. That's when they buy buildings, equipment, things of that sort. And then $7.98 billion returned to shareholders or owners, what they call. Okay, now if we look at the earnings summary, everything here is worse than 2021, the same year in 2021. So the street is already looking at this and going, wow, everything is declining. So you would think the stock would get demolished, and if you think that, you'd be wrong. And here we're pulling up the same information. Let's put a 1-year chart on Texas Instruments. Let's put up a 5-year chart on Texas Instruments. You can see it's pretty there, close to 5-year highs on the chart, guys. Not too far away from the 5-year high here. And after earnings today, after the conference call, goes down not even 1%, guys. Not even 1% on the day after these earnings. So what is the market thinking as far as semiconductors, right? The market has to know something that Texas Instrument isn't telling us. So this is definitely either a severe underreaction to not, great earnings at face value, but bad facts as far as the future and the trajectory of the company. So at the end of the day, market not really reacting severely to these Texas Instruments earnings. What it tells me as a watcher, as an observer of the stock, the market was already expecting all of this to happen. Okay, now let's move on to DR Horton real quick. I want to touch on DR Horton. So these guys missed, or not didn't miss. Excuse me. No, they beat. Very surprisingly beat their profitability by a significant amount. And almost $1 billion, $130 million short of $1 billion in revenue. And you think, how are they doing this? How are they pulling this off, right? So they beat by 48 cents, 50 cents on profitability, almost $1 billion in revenue. And they're saying, hey, the sales only increased 1%. Like, sales of homes only increased 1% to 6.7 billion. 17,000 homes closed compared to 18,000 the same quarter in 2022. So their fiscal quarters are a little bit weird, right? But at the end of the day, they're closing just a little bit less homes at the same period last year, when it's a seasonally slow time, when interest rates are so high. But they're saying, look, check it out. So the average sales price of net sale orders in the first quarter was $367,900. DR Horton is not this premium home builder, guys. It's not Toll Brothers. It's not, what are the ones? Lennar. It's not any of that, right? So an average sales price of $367,900 is still pretty hefty for the interest rate that you'd be paying against that loan, and it's down 4% from the prior year. I would say only 4%. It should be down higher than that. So it tells me that these guys are executing pretty well in whatever their strategy is. And again, I'm not an owner, nor do I want to be an owner, but I'm watching this for the health of the housing market, because we own Rocket Mortgage, and we care about the health of the housing market and knowing where that's going. So they're saying they're continuing to offer mortgage rate interest rate locks and buy downs. Okay, so that's incentives that they themselves are providing, and other incentives to drive traffic to our communities. We're reducing our home prices where necessary to optimize the returns of our inventory investments. Okay, now I was reading the call transcript. They talked a lot about cancellations, somewhere in the vicinity of 25 to 30% of active cancellations. So it's not all good. This is a lot of face value stuff here. Not all good, but you would think, hey, check this out. The stock reacted pretty okay, right? But this is also a stock that trades very cheaply on its valuation, right? So it has a trailing PE of under 6 and a forward PE of under 10, right? So a lot of bad pricing in the stock, in my opinion, as far as the valuation of the stock. So for a stock with a trailing PE of 5 and a price to sales of 1 to go down, it's tough. I mean, it has to be something very bad going on with that business. And from what I'm seeing here, I mean, there's bad, there's good, but again, not as bad as feared from DR Horton. So we'll take that at face value and keep looking for other home builders to see if everything jives and there's a common denominator that keeps appearing throughout earnings season. Now, that'll be all for today. I'm trying to keep these videos shorter than usual. Please don't hesitate to ask me questions. Let me know how it can be helpful to you. Hit me up on Twitter, on Instagram, where I post the kind of, daily news there on Instagram and a couple funny things here and there. As usual, reach out to me in any of those methods. Peace out.